can always start up a business or start investing in one early. But the question is, do you want to learn the hard way? Why don't you leave that to others who might have gone through all of that just to give you the golden rules of investing? Yes, want to know them? In today's episode, we bring you 5 proven rules to get that early push into investing. Let's get started. First of all, congrats! Investing is the most reliable approach to building wealth over time. If you're a first-time investor, we're here to assist you. It's time to start putting your money to work for you. Now, to do that, you gotta make sure to follow these steps. Number 1, decide on how you want your style of investing. When going on a trip, you have to set your destination, right? And when it comes to investing, you gotta know where you're heading to. When it comes to investing money, there are 2 primary groups: active investment and passive investing. We feel both approaches have their own potential as long as you focus on the long term rather than the immediate term. However, your lifestyle, finances, risk tolerance, and hobbies may lead you to favor one sort over another. So you better don't fall into short-term temptations. Active investing requires you to do your own research on assets and building and managing your portfolio. You aim to be an active investor if you want to purchase and sell individual stocks using an online broker. To be a good active investor, you need 3 things. Let's see: time, knowledge, and hunger. First, you'll need dedicated time. Active investing requires intense studies. You'll need to discover investment projects, perform some basic analysis, and monitor your investments once you've purchased them. Knowledge comes next. You see, having all the time in the world won't assist you if you don't know how to assess investments and study companies correctly. Before investing in stocks, you need to be at least knowledgeable about the fundamentals of stock analysis. Many people just do not have the time to devote to their finances. And because passive investing has traditionally provided high returns, this strategy has nothing wrong. Active investing offers the potential for higher returns, but you must be willing to put in the work to do it right. Passive investment, on the other hand, is similar to putting an airplane on autopilot rather than piloting it manually. You'll still receive decent results with time, and the work required is far lower. In a word, passive investing is putting your money to work in asset classes where the hard work is done for you. Mutual fund investing is an example of this method. You may also use a hybrid strategy. You might, for example, pay a financial or investment advisor or utilize an automated financial bot to design and execute an investment strategy on your behalf. Sounds cool, right? Alright, getting to number 2, how much money do you want to put into it? How much are you planning to? In fact, it would be more accurate to ask how much of your income are you willing to spare. Yes, just like deciding the style of investing, you must first consider how much money you can set aside each month for your investing strategy. There is no minimum deposit amount, and you may begin with a very low investment. The goal here is to set aside a minimum amount of money from your savings and then keep to your promise. Setting a budget includes financial discipline and the reduction of your spending. However, before looking at investing possibilities, you must establish an emergency fund. An emergency fund should ideally be 3 to 6 months of your income, depending on your costs. An emergency fund's goal is to make sure that you have enough money in the bank to cover an unexpected need without risking your investment. Keep your emergency fund in a savings account that you can easily access. It can also help you pay off high-interest loans like credit card debt in some situations. Alternatively, investigate if you can move these to a lower interest plan. Keep in mind that interest is merely another charge on your own account with no rewards. Got it? Number 3, how can you handle risks? Alright, now, risks in this field can be quite scary. Let me warn you about that. We have seen people losing their entire savings on one single investment. Well, that is just because of poor investment practices. But everything comes down to how you can handle your losses. Risk assessment is a broad word that refers to determining the possibility of loss on an asset, loan, or investment. Assessing risk is critical for estimating the value of certain investments and the optimal risk mitigation procedures. It displays the potential benefit in relation to the risk profile. Risk assessment is necessary to calculate the rate of return required by an investor to consider an investment worth the possible risk. This can greatly vary based on your income, spending, responsibilities, and outlook. People who have a large number of dependents, debts, or bills have a reduced risk tolerance. On the other hand, someone with hereditary wealth may be ready to take on greater risk. Your risk tolerance will influence the mix of your portfolio. Those with a higher risk tolerance can invest in high-risk, high-reward equities. On the other hand, investors with limited risk tolerance might choose low-risk, poor-return bonds. Even among these groups, risk profiles might differ. Blue-chip equities, for example, will be less risky than lesser-known ones. Now, along with risk assessment comes stop losses. Now, you might be confused about what's a stop loss. Whatever your risk profile, defining the amount of loss you can tolerate is always a smart idea. A stop loss order is useful in this situation. It is a purchase or sale order made with your broker when a stock reaches a specified price. So, if you put your stop loss order at 15%, your broker will sell a stock if its value goes below 15%. Number 4. Setting up a time horizon. Yes, an investment time horizon, or simply time horizon, is the amount of time one anticipates holding an investment until one wants the money back. Time horizons are mostly determined by investing objectives and techniques. Saving for a down payment on a house, for example, would be considered a short-term time horizon, while saving for education would be considered a medium-term horizon, and investing for retirement would be considered a long-term time horizon. An investment time horizon is the amount of time one anticipates to keep an investment in order to achieve a given goal. Investments are often classified into two types, riskier and less risky. The longer an investor's time horizon, the more aggressive or risky a portfolio can be built. The more conservative or less risky the portfolio that you may desire to adopt, the shorter the time horizon. Growth stocks with strong returns might be chosen for a short-term horizon. However, in the intermediate or long term, where such stocks may carry a larger risk, this may not be appropriate. An intermediate portfolio might benefit from a diversified portfolio of equities and bonds. In comparison, a longer-term time horizon allows for bigger stock investment since you have time to recover from a loss and let the stock develop. Got it? Number 5. Understanding what all you have at the moment. Yes, it is all about options. After deciding how to invest, you must determine what to invest in. Every investment carries risk, and it's critical to understand each instrument's risk profile and whether that risk match your objectives. Stocks, bonds, mutual funds, and so on are among the most popular assets for individuals just starting out. As a result, a bond is simply a loan to a corporate or government organization that commits to repaying you in a set number of years. Meanwhile, you're gaining attention. Bonds are less volatile than stocks in general since you know when you'll be paid back and how much you'll receive. Stocks, on the other hand, generate lower long-term returns. Therefore, they should occupy just a tiny portion of a long-term investment portfolio. Following that, we have a mutual fund. A mutual fund is a collection of investments that have been pooled together. Mutual funds allow investors to avoid the process of selecting individual stocks and bonds by purchasing a wide variety in a single transaction. Mutual funds are less hazardous than individual assets because their data is expressed. Exchange-traded funds are next in line. An ETF, like a mutual fund, contains a collection of individual investments. The distinction is that ETFs move like stocks throughout the day and are acquired for a share price. Now, these are the most popular investment options you have at the moment, and there's plenty of time to start learning and practicing investing. Investing while you're young is one of the greatest methods to get a good return on your investment. Because of compound profits, your investment returns begins to earn their own return. Compounding is the process through which your account balance grows over time. At the same time, many people ask if they can get started with little money. In a nutshell, yes. As we said in the beginning, investing with smaller dollar amounts is now more possible than ever before because of low or no investment minimums, zero fees, and fractional shares. Now, coming to the end of today's episode, this is just an outline of what investing is. Want to know more about these options? If so, then do stay tuned to our channel. Anyways, do mention your views in the comment section below. We'll meet again in the next episode. Until then, bye!